Hi, it's Alan Laupsch with Financial Network Analytics, and welcome to FNA Correlations. You can see here our cross-asset class ETF monitor, and we can see that there was a big bounce on Friday with many positive surprises following the ECB rate cut announcement on Thursday. Germany was the biggest positive surprise with a 2.26 standard deviation increase, and you can see the rest of Europe fared quite well. Global equities as well as Japanese equities and Asia and China all reported significant upside surprises, and the top sector was real estate. However, despite the positive backdraft of central bank support in Europe as well as in China and globally, it makes sense to have a well-diversified and balanced portfolio. We can see that systematic risk is very high here, still at 55% in this cross-asset class portfolio. For equities, systematic risk is even higher, close to about 73%, meaning that 73% of global equities risk is explained by the first factor. So it makes sense to construct a balanced portfolio and to have diversifying assets, and ideally assets that are even negatively correlated. And we can see three assets stand out here that have a negative correlation. Gold has received a lot of hype, and we can see here gold has a negative 0.53 correlation, and that strongest link is to Chinese equities. So for Chinese investors, obviously gold could be a good bet. What's interesting though is to note that gold does not have a stable negative correlation. That correlation has declined a bit from its peak of negative 0.62. For global investors though, you would rather consider the 20-year government bond, which has the highest correlation here, to risky equities. So that correlation is negative 0.71, and I'm just going to zoom in here, and that is to US financials, XLF, right? And so you can see that correlation here. And let's click on the 20-year government bond here to look at that asset. That correlation has been fairly negative throughout time over the last year, with a brief positive blip in December. So that's quite a reliable flight to safety asset for global investors. And then we also have the Japanese yen, and the Japanese yen has a negative 0.66 correlation to US financials, and that correlation also is quite negative, and the last time that was positive was before the June 29 mini flash crash. So it's quite interesting that ever since that first mini flash crash, the Japanese yen has been fairly consistently negative. So that would be our second choice for a flight to safety asset to balance out a global equities portfolio. Thank you for watching. If you have any questions, please feel free to email me at alan@fna.fi.